Over the past year, we have been in the midst of a massive bull run. If you bought pretty much any stock in the S&P 500, you likely made a lot of money. And to put this into context, over the past year, the S&P 500 is now up nearly 40%, which is pretty amazing. But despite this, over the past year, we've been able to find a few examples of quality stocks that appear to be undervalued. And in this video, we're going to be looking at 3 dividend stocks that are currently trading close to their 52-week low. So let's go ahead and jump into it. Now, our first 52-week low dividend stock is one I talked about before, and that is United Parcel Service, UPS. The stock is currently trading at about $135.34 per share, and we can see over the past year, the company's down around 1%. And again, if we put this into context, compare that to the S&P 500, we're talking about a pretty massive difference, 40% versus down around 2.48%. Now, this company recently released their latest quarter's earnings report just a few weeks ago, and we can see they actually saw a beat on top and bottom lines. So if we actually zoom in just a little bit here, we can see right here, this is where they reported their latest quarter's earnings. They went from around $131 per share all the way up to close to around $140 per share. So this was a decent jump up, but we can see since then, the stock has continued to sell off slightly and is settled at around $135 per share. Now, if we jump over to my dividend breakdown sheet and come up here and plug in UPS, and we can see all this data will automatically load in. And real quick, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, we can see UPS is currently a big dividend payer. Look at that starting dividend yield, close to 5%. That is a big dividend yield, sitting at 4.82%. And we can see they actually had a massive dividend hike just a few years ago. In 2021, they paid out about $4.08 in dividends. In 2022, they bumped it all the way up to $6.08. So this was a huge dividend increase, and after that, they bumped it up to $6.48. But their most recent dividend hike was actually a very small one. It was about $6.52. So very little dividend growth. Now, why did they have 2 massive dividend increases and the most recent was so low? And remember, when it comes to increasing dividends, it always boils down to free cash flow for most companies. Look at this. If we come over here, we can see 2020 to 2021, there was a massive increase in the amount of free cash flow the company generated. They went from around $5 billion in free cash flow to in 2021, over $10 billion, close to $11 billion. And we can see right during that time period is when we saw a massive dividend increase. Because of the growth in free cash flow, the company felt like they could really increase their dividend at a high rate. And the next year was a pretty good year for free cash flow as well. A little bit lower, but still quite a bit higher than it had been over the past decade at about $9.3 billion. Now, during that time, it looks like they paid out about $5 billion in dividends. But here's where things start to get tricky. The next year, free cash flow continued to go lower and settled at about $5 billion, while dividends paid out was actually about $5.37 billion. Now, this isn't a good sign if free cash flow does not cover your dividends. In fact, it likes to make paying out those dividends unsustainable over the long term. So we can see that led to a free cash flow payout ratio of around 105%, not a good sign, and an earnings payout ratio of about 80%. So yes, the dividend yield right now is really high. They have seen some pretty good dividend growth over the past 10 and 5 years, but will that dividend be sustainable moving forward? Well, we can actually get a little bit of an idea when we look at the company's capital allocation policy that they talked about in their recent earnings report. Now, to start out, we can see, again, this was Q3 2024, cash flow and capital allocation. Cash from operations was about $6.8 billion. Free cash flow so far is about $4 billion for the year, and dividends paid out is expected to be about $4 billion. So let's kind of get an idea of exactly where we're at. We can dig into this a little bit more if we jump back over to our dividend breakdown sheet. Again, we can see in 2023, the company generated about $5 billion in free cash flow, and the dividends they paid out was sitting at about $5.3 billion. So we know on a baseline, in order to cover all the dividends they're going to pay out in 2024, it's going to have to be a little bit above $5.3 billion. So let's scroll down and take a closer look at this right here. What we can do is see how much free cash flow they've generated in the first 3 quarters of 2024. And again, we can easily do this using the ticker data function. So I'll do equals ticker data, just come select UPS, select free cash flow, and then select 2024. And to start out, we want to look at Q1, and I'll hit enter. And we can see in Q1, they generated around $2.28 billion in free cash flow. And if I just go ahead and drag this down, we can see Q2 was a little above $1 billion and Q3 about $655 million. So if we just simply add all 3 of those quarters together, we can see as of right now, free cash flow for 2024 is sitting at about $4 billion. So it looks like Q4 is going to be pretty important to making sure that free cash flow covers their 2024 dividend payments. And we can actually see a little bit more about this on the investors presentation. If we scroll down right here, we can see free cash flow for the full year. The outlook is expected to be about $5.1 billion. So they're expecting about $1.1 billion in free cash flow in the fourth quarter, but we can also see they're expecting a dividend payout of around $5.4 billion. So I think the company kind of finds himself in a pretty difficult situation right now when it comes to the amount they're paying out in dividends and the amount they're generating in free cash flow. Back just a couple years ago, everybody was super excited to see this massive dividend hike. But a dividend hike like that is only good if it's sustainable. As much as I like to see the holdings in my portfolio grow their dividend payments, it really doesn't mean anything if those dividend payments aren't sustainable. Now, that's not to say they're going to have to cut their dividend payment. We'll see what happens moving forward, but again, it's looking like this dividend payment is becoming a little more riskier. Now, next up on our list, we have the Hershey Company, stock ticker HSY, and for a long time, this has been considered a great stock for dividend investors, but we can see the past year has been pretty rough. Down about 1.68%, so pretty similar to the stock we just saw in that sense. Now, the company's trading at $182.85 per share, and we can see very close to that 52-week low. The 52-week low is around $179, so they're pretty much right at it. Now, if we look at just the past month alone, the company's down around 5.6%. It's continued to sell off, and we can see they have an upcoming quarter's earnings on November 7th, so we're just a couple weeks away, and if we look at the revisions that we've seen in the last 90 days, looks like analysts are actually pretty bearish on this stock as of right now. Now, let's start to get an idea of what's going on with this company. One of the things we have to understand about Hershey's is they have to import and buy a lot of cocoa. And if we look at the price of cocoa over the past 6 months, we can actually see it looks like it's been up and down a little bit. For the most part, it's been coming down. Now, on the surface level, that seems like a pretty good thing, but let's put this into context. Look at cocoa prices in the past year. They've surged at a massive rate, and if we look at it in the past 5 years, it's ridiculous. We can see for a long time it was staying in this range right here, but it looks like it's more than doubled in price since then. So right now, this is a huge problem for Hershey, and we can actually get a better idea of how this is affecting their margins. If we jump over to my profitability and income statement sheet and come up here and plug in HSY. And here's what we can see. If we look at the gross profit ratio 10-year average for the company, sitting at about 45%, and we can see it's been relatively stable during the past decade. 2023, it's sitting at about 45.24, which is actually slightly higher than that 10-year average. But what's it been like in 2024? Well, let's take the most recent quarter, for example. Again, if we scroll down, and again, we can use that ticker data function to automatically pull this in. We'll say we want Hershey's, say we want gross profit ratio, and we want it for 2024, and then the most recent quarter, which is Q2. So I'll hit enter, and immediately you can start to see how the commodity market is affecting the gross profit ratio for this company. That's a pretty big decline overall, going from about 45.24% in 2023 to in 2024 Q2, it was sitting at about 42.43%. So overall, that's a pretty decent difference. Now, if we simply look at the earnings for the company over the past few years, it's actually been pretty stable growth, something I really like to see. And if we jump back over to my stock screener tab, let's come up here and plug in HSY. And what we can see, like I already pointed out, our earnings grew at a pretty high rate over the past decade. Free cash flow followed. Something we can see also, they have been buying back some shares, but it's not really a huge focus for the company overall. But one of the things that surprised me is return on invested capital is actually a little bit higher than I expected it. Typically, you see pretty high qualities with return on invested capital, close to around 20%. And again, this is telling us how profitable are the projects the company is reinvesting their capital back into. But this company's consistently been at least at about 15 or 16%, and on the high end, sometimes as high as about 24%. So that's actually pretty impressive. So the capital they're using to reinvest back into the business is generating really good returns. Now, exactly how much capital are they reinvesting back into the business? Well, we can start to get an idea of this when we look at that free cash flow payout ratio again. If we come up here and plug in HSY, and what we can see is the company is using 57% of their free cash flow to currently pay out dividends. So what does that mean? Well, they have around 43% of their free cash flow left over to either reinvest back into the business, buy back shares, pay down debt, or attempt mergers and acquisitions. And like we already saw, they're using very little capital for share buybacks. And if you'll remember, the debt to assets ratio appears to be in a healthy level, so I don't necessarily think they have to be aggressive when it comes to paying down debt. So I actually think this is a company that's in a decent position, especially when you consider the dividend metrics. Look at this, starting dividend yield now sitting at about 3%, with a really good dividend history, 10-year dividend CAGR at about 10%, and a 5-year sitting close to 13%. And we can see free cash flow has been easily covering those dividend payments, especially for the past few years, so the dividend looks not only sustainable, but I expect it to continue to grow over time. So is Hershey facing some headwinds? Yeah, there is no doubt. Cocoa prices have absolutely surged, and that's something outside of their control. And it's something to be aware of for sure if you're interested in this company. But I do think the company trading this low could be a little bit of an overreaction. Sure, maybe they don't deserve the massive run-up that we've seen with the S&P 500 over the past year, but I do think there could be an opportunity here with Hershey's. Especially if you're a dividend growth investor, you can get in with a decent starting dividend yield at about 3%. And to give this even more perspective, if we go over to Seeking Alpha and click on dividend yield for Hershey, we can see this is the highest dividend yield they've seen in the past 5 years. So could be a good opportunity, and if we look at the past 10 years, pretty much the same is true. Highest starting dividend yield Hershey's has seen in the past 10 years. So definitely keep this one on your watch list. And then finally, we have Occidental Petroleum Corporation, stock ticker OXY, trading at about $50.63 per share. And this is a company I've been talking about over on Twitter. Follow me over there if you are on Twitter. But one of the things I want to point out is, yes, the company's down around 18% in the last year, trading at about $50 to $51. But look at this, the 5-year average forward price to earnings ratio for the company, sitting at 31.78. So this is close to where they typically trade. But the current forward PE ratio is sitting at 11.91. So it's significantly lower compared to that 5-year average. So that's pretty interesting. Now keep in mind, that is non-GAAP numbers. And one of the things that I pointed out right here is Warren Buffett has an average buy price for this company of about $54.50. So when we look at the stock price, you have to understand the price it's trading at right now is even lower than Warren Buffett's average trading price. And in fact, Warren Buffett's been adding shares of this company to his portfolio pretty significantly over the past 3 years. We can see it looks like there's been 8 different quarters that he's been adding shares to his portfolio starting back in February of 2022. And this is now the 6th largest holding in his portfolio, making up around 5.75% of his entire portfolio. Now, when looking at the stock, one of the things you have to understand right now is there's conflict in the Middle East, and what this does is it's driving oil prices higher, and this positions OXY for supply concerns. Now, if we jump over to my stock screener for this company, there's a couple of different things you have to understand. When this data loads in, the first thing you'll see is a lot of ups and a lot of downs, and you're probably a little confused with what's going on here. Why would Warren Buffett buy a stock like this? Well, you have to understand energy companies are very, very cyclical. But you also have to understand they have very high levels of capital expenditures, which is going to mess things up like free cash flow. So for example, if we go over to the dividend sheet, let's go ahead and plug in OXY here too. What you can see with this company is there's been a lot of years where the dividends paid out is actually a little bit higher than the free cash flow they generated. But again, energy stocks are a little bit different. They have high levels of capital expenditures, which makes it kind of difficult to tell whether or not free cash flow is the best way to judge the safety of the dividends payout. Actually, in the case of energy stocks, I typically favor the payout ratio a little bit more. Now, we can see the company's payout ratio right now sitting at about 36.4%, so the dividend looks pretty healthy at about 1.74%, but keep in mind, looks like they did slice that dividend after 2019 when 2020 hit. But since then, they have been slowly recovering those dividend payments. If we scroll down, let's look at this on a quarterly basis. Again, you can see the dividend cut was pretty significant overall, but again, they're working on getting back to those pre-2020 levels. Again, if we look at the stock screener, you can see the company's very cyclical. The financials go up and they go down. That's just the reality of the industry that they're in. And if we jump over to the profitability and income statement sheet, you're going to see the same thing. Look at how the gross profit ratio has fluctuated throughout the years. We're talking about massive fluctuations from as high as around 47% to even around 48% in 2022 to as low as around 6 or 7% in 2020. So here's what I think about this company. I think overall it's actually a decent company and you can definitely make money with them. In fact, if you look at how they've done over the past 5 years, yes, they're only up around 20%, but if you bought at those 2020 lows at around $9 or $10 per share, you've already seen a 5x even with the underperformance over the last year. But as for me, I like to keep my investing strategy very simple. I don't want to buy stocks that are super cyclical. I love stocks that are predictable with their earnings and their free cash flow, and also very predictable with their dividends. I don't want to have to try to time the market with the stocks that I buy. Yes, I love buying them at 52-week lows, but I much prefer to make investing as simple as possible. So I do think there's money to be made here with this stock, but it just doesn't fit into my investing strategy for the long term. But there you go, those are 3 dividend stocks currently trading right at their 52-week low. Go ahead and let me know what you think of those companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.